of the Lead Lag Report. Joining me for the hour is Mr. Gary Black, who I'm sure a lot of you have seen over the years. Gary, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets? And are you always amazed at how emotional people get around Tesla?
It's probably the most emotive stock I've ever owned, to be honest with you. I've been on Wall Street since 1992. I started as a research analyst covering food, beverage, and tobacco stocks for Sanford Bernstein. And when Alliance bought Bernstein, I guess it was about 2001. I went to Goldman as a full partner and not bounced around, but was there for a while. And then became CEO of Janus Capital, big growth shop out in Denver, after it had fallen on hard times, and tried to fix it by creating teams. And I've done a couple other things since then. I left there about 5-6 years later, and then started my own hedge fund. And then most recently was at Aegon as CEO of the U.S. business. And what I like doing is managing money. Managing people is not that fun, as Elon will tell you. Nobody's going to walk into your room and say, "Hey, you're doing a great job managing everybody." It doesn't happen. People come in when they want to complain about things. So I just said, look, in my point in my career, I like managing money. So I started my own fund a couple of years ago with a guy by the name of Dave Kalis, who was somebody who worked for me. And we have a long only concentrated growth product called Future Fund, FFND, traded on New York Stock Exchange, actively managed, high beta, high alpha. And we're going to be launching a long short product, FFLS, in about a month, also on the New York Stock Exchange. I got involved in Tesla back in 2019. I test drove one down in Florida and thought it was like the coolest thing. Many of you, know that feeling when you first drive a Tesla. It's just different, high tech, a lot of acceleration. It just felt like, something that was definitely on the come. Came back from wherever I was on vacation and built the model and said, wow, street's pretty negative on this, but it looks like it could be interesting. So I bought some stock, and, the rest is history. When I bought it was about $16 a share. I got out once. People remember this when Tesla bought Bitcoin. I just thought that was wrong. It was about $1.5 billion of Bitcoin. And I remember they wouldn't provide guidance. So I got out, and this is, back before the splits. I think the stock was about 870. Then got back in when it was below 600. And I've been in it ever since. And look, I've had my times when I've thought about getting out again, to be honest with you. And as a PM, you get paid on performance. So, I could like a stock long term, but if I think in near term it's not going to do well or it's going to be dead money, I will get out of a stock. And when Elon bought Twitter, I thought that was bad for the stock because, people don't want to pay for a half a CEO. They want to pay for a full CEO. And more recently, I just feel like his pricing strategy is not going to deliver the results he wants, which, I'm not sure if he's trying to drive affordability. That's what he says. But when you look at what he actually said in the fourth quarter conference call, and we can get into this, he's talking about clearing inventory, but they're increasing production more than they are deliveries. So the question is, as long as he keeps ramping production up, how do you continuously clear inventories when people are not buying as much as he's producing? And that's caused a lot of stress on the stock in the last couple of weeks. They just keep cutting price. So I'm kind of at the same point where I was when they bought Bitcoin, a little frustrated that management is doing kind of not what I would do, I guess, if I was running things. But not that I'm, trying to take over Elon's job. Elon's brilliant, and I'm not. But it just feels like this is not going to pan out the way he thinks it is. So
a lot of areas I want to unpack here. So you go from the analysis on the food, beverage, tobacco side to a strategy that's focused on future investing in businesses that will change the world. You and I both know that doing analysis on stable dividend oriented types of companies is very different than doing analysis on tech companies. What skills from those early days in the 90s have been relevant to analyzing tech and then Tesla in particular?
Well, yeah, and I skipped a lot of discussion there because, again, when I went to Goldman, I was the CIO for the entire active equities team at Janus. It was a growth equity shop. So, I skipped all the parts for time's sake. But, I've done a lot of research on tech companies, growth companies. I think I understand growth. I think what's different about us versus, say, ARC and other growth shops, we're very disciplined about valuation. 90% of the companies we own make money. And so I'm always looking for innovation that's going to, disrupt an existing industry. And, whether it be streaming or whether it be, people make fun of us because we own Chipotle, but, Chipotle is healthy Mexican food and it's very disruptive. And what is valued today is pricing power. And so we try to find growth companies that are disrupting industry that have some pricing flexibility for whatever reason. And, I think we've been successful at that in the, year and a half or so since we've been running the fund. I think what's interesting about Tesla is, like other disruptive businesses, they're disrupting, the legacy OEM business. And what gives Tesla, in my mind, why it's a good value long term is because EV adoption, which was about 10% in 2022, will probably get to about 60% by 2030. So what we tell people, when you want to think about building a model on Tesla, you got to think about global SAR, as standard selling rate, and you can do it by country and then build it up. We look at US, we look at Europe, we look at China and the rest of the world, and then you try to figure out what the Tesla's EV share is going to be. If they could just hold their share and EV adoption continues to grow at 30 to 35% a year, Tesla's volumes can grow at 30 to 35% a year. As I always tell people, you got to compare that to the multiple. You can't just say, well, I want to look at overall industry volume growth. Overall industry volume growth is 2 to 3, but if you want the stock to go up, it's got to at least justify its multiple, which is 30. It's 30 times today, which means you got to get volume growth of at least 30%. So therefore, it has to hold its EV share. The stock is not gonna. It's not gonna work for us. So I think, back to my background, I've always been a growth manager. I've always tried to find disruption. I think what's different about us is we do a lot of on the ground research. We'll go out and talk to customers, we'll talk to suppliers. Because I've been a CEO, I can usually figure out within an organization who I should talk to. Sometimes they don't talk to you, but I can usually find somebody. And, we try to find out like what customers are thinking, what suppliers are thinking. I think I understand the way CEOs think, having been one, and I understand the way boards think, having been on 2 public boards. So I think I bring a lot to the table in terms of, my research, but, we always make mistakes. Obviously, everybody does. And we're always trying to refine our methods as we go along.
I think it's fair to say that valuation matters maybe a lot less when you're at the zero bound for interest rates versus where we are today. And I think you alluded to it a little bit, but I want you to expand on the current valuation on Tesla. I have to say, I'm always amazed at how people seemingly can't distinguish between the person, the company, and then the stock price.
Yeah. That surprises me too, Michael, to be honest with you, because you can love the company, love the company's mission, but you may not like the stock. And so, to your point, we took our position down before earnings because we thought, and I published this yesterday on Twitter, there's 4 reasons it would cause us to sell a stock. One is it hits our price target, and our price target's higher than where it is, so it wasn't that. 2 is that the near term expectations just get too unrealistic, which we thought was the issue. 3rd is just better risk reward, which was also an issue. And 4th is just our investment thesis changes, either because you bring in a new CEO or the company's mission changes. That wasn't the case. It was really the near-term expectations had gotten too high, and there was better risk reward elsewhere. So we trimmed our position. Tesla used to be a 10% position. Now it's under 6. And so the way I think about valuation, which, valuation is still very much there, is I try to look out where the industry selling rate is going to be in 2030. I look at EV adoption. I already told you the number I'm looking at is 60%, and I try to build it up from US, Europe, China, and the rest of the world. And they're all kind of converging on that 60%. And then I try to figure out what Tesla's share is and EV share is. And that's probably the most controversial thing because you got Elon telling people, don't look at EV share, but the rest of the industry does think about it. And so I try to talk the language of, portfolio managers in the industry. And it's the way I build my model. And I can't just take a number out of thin air and say, okay, well, its overall share is going to be X. You could figure out overall share. You just take EV adoption times EV share, you get overall share. And so I have EV share kind of stabilizing at 20%. And the reason, even though it's been falling recently, is because you got the Cybertruck coming and you got the $25,000 vehicle coming, both which I think are game changing. So when I get out to 2030, I have about 10 million units being sold, which is 85 million SAR, 60% EV adoption, 20% EV share. That gets you about 10 million. And then I have earnings for 2030 of $24 a share. And then I try to put a PE on Tesla where the PE will be in 2030. And that's based on the future growth rate. So the future growth rate I have in 2030 is somewhere between 15 and 20%. So I put a 30 PE on it, which is actually where it trades today, because people are discouraged by this stock. That's why it's trading at a low multiple. Actually, Chipotle's multiple, which is our number 3 position, is higher than Tesla, which is interesting because it's got a lower expected growth. 30 times 24 is 720. And then you got to figure out an appropriate discount rate back. We use a risk-free rate of 3.5, which is a 10-year Treasury yield. We look at Tesla's beta for the last 2 years, which is 1.6. And usually equities in general reward about 6%. They call this the equity risk premium more than Treasury bonds. So you take 3.5 plus 6 times 1.6 because it's the beta. You got to risk adjust it. And that gets us 13.1. You discount 720 back by 13.1% for whatever, 6.5 years, 6.75 years, you get 320. So from a valuation standpoint, the stock seems pretty cheap. And so people have asked me since we took our position down, if you have a $320 price target, why would you sell a third of your position? And it's a fair question. But if you think that the estimates are too high, and as a growth investor, you've got to pay attention to this stuff. And, you could look at Chipotle today, where the stock's up, 12%, or Microsoft, and the expectations matter. And so what we thought was last week before earnings, Tesla took down prices again, third time, not sixth, but third time this year. And we didn't feel that the street was accurately reflecting those price cuts. So the day before earnings, we had no knowledge about what they were going to report. Of course, we don't traffic in that type of information. We just felt estimates had to come down. Since that last price cut, estimates have been down 11%, stock's down 11%. And so, we feel probably the number 2 question I get is what happens if the stock gets to 150? Because we've told people we think, Tesla will trade in a range between 150 and 200. Today it's at 157 or so. Will you start buying it? And the answer is maybe, if we think the expectations are realistic. And so the street has brought estimates down. I think at this point, it really comes down to whether Elon's going to honor what he said on the conference call, that they aim to have industry-leading gross margins. Today, they're at industry margins. One of my favorite analysts to read is Tony Sacconaghi at Bernstein. He's posted a table, which I posted on my Twitter feed, shows how Tesla's gross margins compare to everybody else's. So they're 19 in first quarter, it'll be 17 in the second quarter. The industry's at about 17 now. So the question is, will he go below that and keep taking prices down? And that's the, I want to call it a $64 billion question, because, at this point, inventories are the highest they've been since before they took the January price cuts, both in the US and Europe. And Model Y seems fine. It's Model 3, Model S, Model X that, seem to be growing in inventory so much. Model Y, I think, it's a great bargain if you think about it. It starts at 46.9. The long range, which is, the best selling trim, is at 49.9. Plus you get this $7,500 credit. It's a great value for consumers today, especially when you factor in, the operating costs are as low as a Toyota Camry. The problem is there's no advertising, so nobody knows about it except, people who follow the website. So that's the challenge, is what are they going to do about the inventories, which continue to grow higher and higher? And I hope that he just stays with the current pricing. I hope he realizes after all these price cuts, he's not going to get a lot of volume growth. The elasticity is very low, despite what he says on the conference call sometimes, where, he's talking about orders being in excess of production. That was not true in the first quarter. Production exceeded deliveries by 18,000. And for the last 3 quarters, they've exceeded deliveries by 80,000. So the question is, as you get into the quarter and inventories continue to grow, are you going to keep cutting price or to clear inventory? Are you going to try to keep your margins where the rest of the industry is? And I'm hopeful he's going to try another tool. Pricing is a tool, just like advertising is a tool. You're trying to drive demand, and the question is what works better. And I think you need a combination of both. And we haven't tried advertising yet, and I'm hopeful that he will.
I want to expand on the advertising in a bit, but let's get to some of the audience. Go ahead.
Well, here's the thing. So and I'm a big champion of the Model Y, we'll call it standard range, which starts now at 46.9. The Model Y long range is 49.9. And I believe in price points, and so getting below that $50,000 price point is important. You get people into the store, the Tesla store, you get people to the website. And look, the goal of a salesperson is to upsell them once you get them in there. And so having that 46,990 car, which is about where the average car in America starts at today, that's the average selling price of a car sold in America. I think it's really important strategically. The 279 range is not great. I think, and so this is where the educated consumer will start, doing comparisons. But relative to the rest of the industry, it's not bad, and I think you'll sell some. I think it's a great way to get people into the Tesla franchise who want a bigger car. Me personally, I can't fit into a Model 3. I'm 6'2", and I try to sit in the back seat, and I'm uncomfortable. Or a Model Y. I used to have a Porsche Cayenne, and it was my model, which I have a Model Y now. The Model Y has got just as much room as the Porsche Cayenne, and so I think it's a great product, and it's a great value. And to me, I think the Model Y long range will continue to be the main seller. I don't know what the percent of the mix is, but let's call it at least 70 to 80%. The Model Y performance is for people who are willing to pay. I guess it's an extra four grand. I think it's at 53.9 now. But I think having that standard range is a great option. And like even back on Model 3, I don't know why there's no long range Model 3. You got the standard range, and you got performance. And the performance, by the way, is only priced $1,000 below the Model Y performance, which makes no sense to me. And then there's no long range. And I don't know if that's because they're bringing out a new, there's rumors about a new Model 3, this Highland project. Maybe that will replace it. But right now, you can't get a Model 3 long range, and Model 3 seems to be struggling in terms of selling. Sure. And look, I use a number that's close to 2,400 per vehicle, but your point is well taken that you make money on that $46,990 vehicle. Look, I don't know what can get demand moving again. So here's the fundamental issue with Tesla as a stock, and the reason the earnings keep going down. You're increasing production at a rate of 50% per year. That's the standard. That's the goal that he's had for a while. And yet underlying deliveries are increasing at between, let's call it 32 to 35. How do you bridge that balance? And so you could argue by cutting price, you're going to bridge that balance. I'm skeptical. And the early data that we've seen since they cut price, it's only been a week, is suggesting that they're not really getting much volume growth out of it. And we could talk about the reasons why. But I still think that Model Y standard range is a great value for the money because it is priced right in line with the average new car price in America. And so, the question you have to ask yourself is with 10% EV adoption globally, in the US, it's probably 8, okay? What is it that causes people not to buy a Tesla? And I go back to, it's what you said, it's people are afraid they're going to run out of juice. I hear that all the time from smart people who can afford a Tesla, but they don't want to buy one because they're afraid that they're not going to be able to, get from point A to point B. And so they're afraid of that. And there needs to be an education that says, look, that's not going to happen. We have 45,000 charging stations or charging ports around the world, 20,000 or so in the US. And, here's how easy it is when you get it installed in your garage. And maybe Tesla should do something in terms of a promotion of like maybe give away free chargers, which cost $500. And then, maybe installation is free. I don't know, where you can get it installed in a garage if you own a garage. And then it becomes like plugging in your iPhone at night. And I don't know why they don't take a chance at, trying to educate people more on this, what they call range anxiety. And it's you see it in all the surveys next to cost. That's the number one reason why people don't buy an EV, right? So I just wish Tesla would try overcoming that range anxiety, because I think by focusing on the whole category, EVs as a whole, and trying to drive EV adoption, it's going to benefit Tesla the most because they have the biggest share. Look, having been involved, I started my career as a product manager on Tylenol. Once you start playing with ads, there's definitely and Elon's a very creative guy. There's definitely a sense of accomplishment when you put an ad on TV and it works, and you get people, interested in your product. I think he would have a blast working with the ad execs trying to come up with ads that educate, tell the story, get people to buy more EVs. I don't understand, and maybe somebody here can explain it to me, what the reluctance is, other than he believes principally that the product should sell itself, which, you could argue that about any product. You could argue that about iPhone. And yet, Apple's spending, I don't know the number, but let's call it $3 billion a year on advertising. It must work or they wouldn't do it. They wouldn't spend that much money.
Well, but if it is an education campaign, presumably, I don't know if he's thinking in these terms, but all the other competitors are going to need to address the same issue of range anxiety. So why not have them spend the ad dollars to educate the public? And Tesla's front of mind because of availability heuristic anyway. So let everyone else spend on it rather than Tesla.
Okay, but is it really a cost issue, or is it a principle that we shouldn't have to resort to advertising? And look, Tesla, if they did that, what I call category advertising rather than comparative advertising, where you're talking about your cars versus other EVs. So comparative advertising, you're trying to drive EV adoption. You're trying to say buy an EV instead of an ICE vehicle. And you basically should be talking about the lower operating costs. You should be showing the ease of charging as opposed to going to a dirty, filthy gas station. You should be talking about the near autonomy you get. You can't, it's not full autonomy yet, but the autopilot, enhanced autopilot, even if you don't want to spend $15,000 or $199 a month on FSD, is something you don't get with an ICE car. You talk about the power, and acceleration definitely sells cars, and Tesla has great acceleration. You talk about the residual value because people are going to worry about fear of obsolescence, and you talk about saving the planet. And those are all things that Tesla, if they were to take those different quote features of EVs and show Tesla as the product in the ads as opposed to anything else, I think they would get a lot of mileage out of it. Why would you want Lyric or one of the other competitors to show their cars? I just think Tesla, if it's money, every $1,000 cut is worth $500 million. Take 1/10 of that and say, okay, we're not going to take another $1,000 price cut. We'll spend 1/10 of that and we'll try it and see what happens. Try it in a controlled test market. And usually with advertising, and this is an important point, advertising is not a short-term tool, it's a long-term tool. You don't usually see the immediate response. It takes a while. Where with price cuts, it's a very blunt instrument. If you take marketing classes, you'll hear the term sugar high, promotional narcotics. There's all kinds of words, pejorative words that people use to describe discounting, but it's a short-term tool. It's not a long-term tool. And for a guy who prides himself on thinking long-term, I'm surprised he's resorting to short-term tool called pricing, discounting to drive volume, as opposed to trying to do something more long-term, building brand equity and trying to, accelerate EV adoption. That's a very long-term process. And I don't, if again, somebody who prides himself on thinking long-term, why are we short-term discounting to drive volume? It's bewildering to me and others.
Everybody, please make sure you follow Gary Black on Twitter if you don't already.
The question is, what does Elon want? Does he want everybody to follow him down on pricing, or does he want him to resist it as what, I don't know, some CEO, I think the CEO for Nault was talking about it yesterday, and saying, we're trying to resist taking prices down. Does he want everybody to follow him down to make EVs cheaper than ICE vehicles, which is, to your point, that's what we define as a price war? Or does he believe nobody else has the margin flexibility, which is what he said on the conference call, to basically take prices down to where profits potentially, he's not saying he's going to do this, but he said potentially we could do this. We could, I think he used the word theoretical or some descriptor like that. Technically, I think he said we could take prices down to where we make no margin. We're the only ones who can do that. And I don't know the answer to that. I actually think he'd prefer if everybody followed him down, because it accelerates EV adoption even faster if everybody is charging what Tesla is. So I don't know the answer to the question. What the goal is? Is the goal to get everybody else to follow him down? Clearly, with the lowest cost structure of everybody, because they've been making EVs for whatever 10, 12 years. He drive prices down quicker than anybody if he wants to. But at the end of the day, would he do that? I struggle with that one, because when I think of Master Plan 1 and the whole concept of bringing out new products to drive affordability, so Roadster to Model S, Model S to Model 3, Model 3 to what we used to call Model 2, although, they've said they're not going to call it Model 2, that's fine. But the $25,000 vehicle, to me, that drives affordability, where if I take the Model Y price from here, let's just say 49.9 is the right price for Model Y long range. Let's not, quibble about it. To take it down another $1,000, does that really drive affordability, going from 49.9 to 48.9? If you were to look at an 8% loan rate over 60 months, that's $18 a month on a $1,000 a month car payment. I just don't think that drives that much volume. And I think whether he realizes this or not, I got to assume he realizes it. He's not going to get a lot of incremental volume in the second quarter by cutting price any further. So the question is, once he realizes that, or his team realizes that, what does he do? Does he just keep taking prices down? It's like pushing on a string, because you're not getting that much demand elasticity. And there's lots of reasons, and we could talk about the reasons, because I think that's helpful to figure out, why are you not seeing much demand elasticity, which is the whole point of Tony Sakonakis' report from the other day, which got a lot of play in the marketplace. I mean, a lot of people I talked on institutional read what Tony puts out. CNBC was quoting it. And that's why I read his reports, and that's why I encourage you to read it, because at least what the bears are saying. And he's a very, he does his work. It's not like he's making up stuff. He actually does do the work from an analytical standpoint. Well, I still think it's a selling point. And so when I think of what I do to sell EVs, I talked about operating costs. I would show how easy it is to plug in. You don't have to go to the gas station. It's the technology, it's the power. The residual values are much higher as a percentage of cost. And I don't know if I would play to the obsolescence fear, but I would clearly, mention it if I were doing ads, that if you buy an ICE car, you may not have a lot of residual value left when you try to sell it. And I still think saving the planet is a reason people will buy EVs. Now, the question becomes, and I think Ross Gerber has brought this up, this is his thesis, have you already gotten all the early adopters in 2019, 2020, 2020, because you clearly had a Model 3 that was affordable for people. And now you're kind of in the next level. The people who are trying to save the planet, you've gotten those folks as buyers. Now you got to go to the next level to get people who may like an EV. They may like the concept. They may like the idea that it costs cheaper to operate, but they're afraid, they have range anxiety. And how do you overcome that? And to me, I think that's what Tesla needs to be focusing on, is trying to overcome the range anxiety and show. And again, I come from a state, New Jersey, where it's one of, I think, two states where you're not allowed to pump your own gas. But like in Illinois, where I live, getting out of a car and pumping your gas is a pain in the ass, especially when it's 20 degrees out. I think it's like such an easy sell of an EV versus an ICE thing, that you don't have to do that anymore. You get into your garage, you plug it in, just like you plug your iPhone in, and the next morning you have 300 miles you can drive, and you do that every night. And I think that's a great way to sell EVs, and use Tesla to call it product as hero advertising, where you're showing Teslas in the ads, and you're going to get a lot of benefit from that. I don't think that's a factor, to be honest with you. I mean, maybe I don't understand your question, but I don't think that's what drives the stock right now. If all of a sudden, there was we won't call it a war, but some sort of fighting between China and the U.S., where China decides it's going to take over the Tesla operations in Shanghai, then yeah, that'd be an issue. But I think that's a very low probability event. And I don't see the U.S. and Europe as decoupling. I don't see that at all. They're our allies. I'm not sure why we would consider that as a likely outcome. I don't know. Maybe I'm misunderstanding the question. There are things that I don't listen to management on, and there's things I do listen to them on, and they've lost a lot of credibility on the whole margin thing, in the sense that they told people 20%, X leases, X reg credits, that they came in at 19, and now they're at 17 or even 16. And to your point, there are 7, 8 manufacturers with higher gross margins than they have. And I just struggle with the whole, we're going to keep industry leading margins when they're already kind of at average margins today. So that's the $64 billion question. That's why the stock is now trading at 30 times earnings, even if you use the worst case outcome, which is that they grow volumes at say 30% instead of 50%, which is kind of what I'm using. Streets, I think, at 25 or 26 going out 5 years. A PE of 30 for 26% volume growth is still very cheap any way you look at it. And I know there's people out there, and there's probably people on this call who say, no, it's expensive because you got to compare it to an auto margin or an auto company. That's not the way finance theory tells you. Multiples are not based on the industry in which you compete. Multiples are based on your future growth rates. And if you can grow, if EV adoption is going to grow at 35% a year, and you assume you can, even just lose a little bit of share, EV share, but you're going to have Cybertruck and you're going to have a $25,000 vehicle, you're going to be able to grow your volumes at 30%. And then a 30, a 30 multiple, which is based on, let's say, a 17% gross margin, is still very, very cheap. So to answer your question, I don't know if that's a floor or not, what the industry gross margin is. That's what they're telling people. But, they've lost a lot of credibility in the last, 3 months for saying things and then not being able to deliver on them. So I can't tell you if they're going to continue to drive gross margins down. I'm not sure if they'll honor what they've said as guidance, right? And look, one of the things that bugs me about Tesla is they're always blaming it on the economy. And I listen to a lot of consumer products companies. Nobody else is blaming the economy for weakness, because you're going to hear tomorrow, Thursday, you're going to hear first quarter GDP. We're still growing at 2% or so. Fourth quarter was 2.9. So when a CEO says, well, it's the economy that's causing our volumes to fall short, but nobody else is talking about the economy as being an issue. It could be, but it's not right now. It wasn't in the first quarter. There's a little bit of a credibility gap. I don't listen to management. As an analyst, you're not supposed to listen to management. You're supposed to take it as an input, but, do your own work, as I always say. So I know Elon says 20 million units by 2030. We scoff at that. Your point about FSD, he's been saying since 2019, the car is going to drive itself. And he said it again on the first quarter conference call. I don't buy that, right? And I've never bought into that. I try to do my own work. That said, the man he's revolutionized the whole industry, and you have to grant him that. And he's created a great product. As Michael said at the beginning, you have to be able to differentiate the difference between the product and the stock. And so that's my job, is to figure out, okay, does this great product still have a great stock price going forward? And that's where the management credibility comes in. And that's why Jeff's question is important, is, do you take their guidance as being gospel or not? And I think they're skating a little bit on thin ice, because some of the things they've promised, just haven't panned out. And the gross margin 20% line in the sand was something that I think a lot of people took literally. And when they couldn't deliver it, that's why the stock is down, whatever, 11% since they announced earnings. So I still accept the man that Elon is brilliant. He's the most brilliant thinker in the industry. I give him a lot of credit for taking a company that a lot of people never thought would get off the ground. Model Y is going to be the best-selling car in the world this year. And I believe that they can get to 10 million units by 2030. I don't believe they can get to 20 million. But I agree with you. You have to do your own work in this business. You can't just take whatever management says as being gospel, because that's how you lose money in the stock market. You can't, and it's not just Elon. There's a whole bunch of people out there that promise things and then they can't deliver on them. And so I always encourage people, do your own work. It's not hard to build a Tesla model. It's quite easy. They give you a lot of research, and there's a lot of third-party research out there to use. So don't just take 20 million as being, the guy, and don't just say FSD is going to work because Elon says it's going to. It may, but as you keep reading, there are a lot of competitors out there spending just as much on full self-driving that are going to be able to master it just as quickly as Tesla. So I've never built that into my valuation. That's why my price target's probably lower than a lot of people on this call. I don't buy that FSD is going to ever give you. It's going to sell a lot of Teslas, but I don't build in a robo-taxi network, because I just don't think Tesla's going to be the only one with robo-taxi capabilities. So that's a long-winded way of answering your question.
I'll expand on that even in the context, since you mentioned that you're doing a long-short fund. Maybe an extension of that question is, what would cause that new fund, if it's part of the mandate, to consider shorting Tesla? I think that's sort of a different way of addressing it.
Look, you have to consider long-term and short-term. So from a valuation standpoint, I come up with a valuation, and it's theoretical, of $320 on a present value basis. I go out to 2030. I talked about how I get it. And I believe that Cybertruck and the $25,000 vehicle are the two biggest catalysts that are going to drive the stock forward. Now, both of those are 24 and 25 catalysts. So they're not going to happen this year. I think in terms of other catalysts, the energy business is going to go up fivefold in the next couple of years. And most analysts on the street don't have that. I think at some point, FSD will reach level 4, but I don't see it happening this year. So I still consider that to be a catalyst. I think once he gets rid of Twitter, being the CEO of Twitter, people are going to accept that as a catalyst. I think a new catalyst, which I've added, is they stop discounting, or they give the signal that they're not going to discount any further. And it's companion assumption is they will start advertising. I now think that's a catalyst because it'll signal that they're not going to just bring gross margins down to zero. So to me, that's a catalyst. So I think most of the catalysts have actually played out, but the two big, I almost need to prioritize them because I put them in order of timing. The two biggest catalysts are the $25,000 EV, which drives affordability, and Cybertruck. And I think with Cybertruck, whether you like the look or not, some people like it, some people hate it. It will drive people to go to the Tesla website, and it'll drive people to go to the Tesla store, and they may not order a Cybertruck, but they may order a Model Y. And I would wish they would come up with a companion pickup, that's more traditional looking for those who don't like it. But you almost have to do the Cybertruck first because it's so dramatically radical. And so one of the things that's interesting about GM is they really focus on pickups. I mean, you listen to Mary Barra yesterday, that's where all their money's going. I wish Elon would spend more money just focus on, because it's 20% of the business. Just like, CUVs, the small SUV is 40% of the business. That's where Model Y plays. I wish they would actually, focus more on the pickup segment. And those two priorities, Cybertruck and the $25,000 vehicle, those should have been the highest priorities over the last couple of years, not robotaxi. Because robotaxi is it's hard. It's really difficult to get there. Ubiquity is definitely an issue. And, if you listen to what Jim Farley said the other day, he said, well, Elon's doing all the right things. And he talked about Henry Ford and, what Henry Ford did. But, at the end, he said, and I think Barron's pointed this out, so I'll give this credit to Al Root, Henry Ford's downfall was he didn't refresh his models. And, you could argue with Model 3, and, there is a new Model 3 hopefully coming out. It hasn't been changed in 6 years. And even the Model S and the X refresh from a couple of years ago really wasn't that different. So I would argue that, they need to do a better job of refreshing their models every couple of years. And again, back on Cybertruck, I would hope that they get the Cybertruck out because that's the highest priority, and then bring out a more traditional looking pickup truck for people who don't like the look of the Cybertruck. But ubiquity is definitely an issue when you think about why hasn't the demand elasticity worked? Even though Elon says it's worked, you just don't see much volume growth as a result of the price cuts. The analysts have not increased their estimates for volume for this year, despite these massive price cuts. They're pretty much the same. It's about 1,000,083 or so for this year. And you would think that if price cuts were, people thought the price cuts weren't, they would take those volume estimates up, but they're not. And I think, we talked about people who are early adopters bought in, and now you got to focus on range anxiety to get more non-EV users to buy. There's a lot more competition. Tony had a good number I saw, 295 new EVs net of retirements, 2021 to 2023 versus 86, 2018 to 20. The third reason that elasticity hasn't worked is serial discounts sometimes cause buyers to wait for more discounting, especially when the media is saying there have been 6 price cuts. There's still this perception that Tesla's too expensive because not everyone's aware of the price cut. And then ubiquity, I think, is important, that if everybody else has the same car you do, and it looks the same. Cars, unlike phones, are an expression of your success in life, what you want people to perceive about you. You're parking it in your driveway. People know what kind of car you drive based on, you dropping off your kids at school. I think ubiquity is a factor, and they really should try to, come up with a refreshed model so not all the cars always look the same. And I think, so even me, and I know Tesla's pretty well. I see a 3 and a Y and an X, and sometimes I have to look to figure out what the difference is, even though I should be able to tell them like within a split second. So the ubiquity issue is out there. And when everybody in a town is driving a Model Y, that's not a good thing from, a ubiquity standpoint. Well, the cost of goods as a result is much lower, right? And that's why Tesla's able to make money. But a lot of it's just scale, right? It's the vertical integration, but it's also that, Tesla's going to make, 1,000,008 vehicles this year. So their cost per unit is going to be much lower than Rivian or Lucid. And I believe that it's more important to compare Tesla to GM, Ford, Stellantis, Volkswagen, Toyota. They're still making, my estimate, $70 billion a year in profit this year. So, when people say, "Well, they're going to test," Elon's going to drive them all out of business, that's crazy. It's like when you look at how much cash flow they generate from their ICE vehicles, they can fund the EV business for a long time. So, your questions about vertical integration, I don't think the vertical integration is what's driving the cost advantage. I think it's the scale, and that's going to continue. And if I'm Rivian, which I think has a good shot of being kind of the number two EV maker down the road, they've got to get better scale. They got to be able to produce 25, 40, 60,000 units. GM is saying they're going to produce 1,000,000 EVs by 2025. We'll see. They produced what, 20,000 in the first quarter, and 90% of those were Bolt, which they're discontinuing. I don't know. I mean, they have no scale in EVs, but at some point they will get some scale, and they can catch up in terms of, not catch up, but they can get closer to Tesla in terms of their cost per unit. I don't think Tesla's always going to have a cost advantage. I guess is that your question? I think they will, but others will get closer. This is probably the biggest debate question I have with my brethren, fellow institutional PMs. What happens if they've taken all these price cuts and they just don't work, meaning they don't get the volume they think they're going to get? And I think that's going to happen. I do believe, because I've studied marketing. There's 4 P's in marketing, and price and promotion are always known as the short-term sugar high vehicle, whereas advertising is a longer-term way of differentiating. I think at some point Elon's going to realize that this strategy of just cutting price before the $25,000 vehicle is ready, because it's not going to be ready till 2025, let's call it. I think he's going to realize this is not the right strategy to just keep taking margins down. And I know PMs out there who disagree with me vehemently, but I think he's going to come to that realization, and he will try advertising somewhere. And I don't know if it's going to be, as you say, some sort of guerrilla marketing. I don't know if it's going to be an expanded, we'll call it a referral program, but he will try it because it's not working. And to your point, the inventories keep going higher, the order times keep going lower. And inventories now in the U.S. are higher than they were before they cut price in January. That's going to mean something, right? And I can go through all the reasons why demand elasticity is low. And his statement that they brought in twice as many orders as production, which proved to be not true, right? It does reduce his credibility when he gets on a conference call. And that's the challenge right now, that people don't believe what he's saying. And I unfortunately, look, I've been a CEO before. You can't make statements like that you can't back up. And I think at the time it was probably true. But as I tell people with price reductions, it is a sugar high. And every marketing textbook will teach you that if you're discounting, you're bringing volume forward that probably would have bought your product anyway. Whereas advertising is a long-term tool. And I go back to my original point. Here's a guy who always prides himself on long-term thinking and tells people, but he's using the most short-term tool to drive volume, which is discounting. And I don't understand that. It's an inconsistent thing in my mind. And I just think at some point, and a catalyst now is he will realize that the strategy is wrong. And at some point they will signal that they're going to stop discounting, meaning the prices will stay where they are, or they'll go up, and they'll start trying to test some advertising. I just don't know when that's going to be. Is it 6 months from now? Is it 2 weeks from now? Is it a year from now? But at some point that's going to happen, because you can't just keep discounting to drive volume, because people wait for another discount. It's common sense.
Well, we do have to wrap at the half-hour mark here, so I appreciate you asking that question. Everybody, again, please make sure you follow Gary Black here on Twitter. Hopefully we'll do another space, and hopefully Musk does advertise so we can pick apart those advertisements. I very much envision sort of a Geico type of style personally. But thank everybody for joining. Thank you, Gary. Really do appreciate it.